This is the Evening Edition.
Well, we begin with what could be a ticking time bomb for California's home insurance industry. Good evening. I'm Ryan Yamamoto.
And I'm Elizabeth Cook. California's insurer of last resort is now warning a major disaster could push them over the financial brink. A growing number of California homeowners are being forced to turn to the so-called FAIR plan as insurance companies leave the state. This latest blow came last week when State Farm announced it would not renew 72,000 policies across the state. John Ramos has a heated debate over possible solutions.
The California FAIR Plan was created in 1968 as a place for people to get fire insurance when no one else would offer it to them. But now, with climate change, so many people have entered the program that just one major wildfire could wipe out every last dollar in the program. Catastrophic wildfires have turned areas that were never seen as high risk into places where fire insurance isn't even available. Sacramento is beginning to see the scope of the problem. Last week, the California Department of Insurance held a hearing about the state of the FAIR plan, and those who run the program didn't exactly have good news.
The FAIR plan continues to grow in size as consumers find themselves without coverage. As a result, we have doubled in size in the last 3 years.
By law, every insurer operating in the state has to participate in the FAIR plan. But if losses exceed the plan's funding, the rest must be made up by the insurance companies, who will pass it on to consumers as a surcharge. Insurance broker Carl Sussman says the size of the FAIR plan now makes that inevitable.
FAIR plan has about $300 billion in total exposure, meaning how much they actually insure, and about $200 million in the bank. So it's not hard to see that in the event of a large catastrophic event, they're not going to have the funds to be able to pay for it.
For many companies, this financial burden will be too great, and they may result in them pulling out and no longer writing insurance in the state.
That's already happening. State Farm just announced that it will not be renewing another 70,000 policies in California. So the state is creating what's called the Sustainable Insurance Strategy, changing regulations that would allow insurers to charge more for homes in high-risk areas.
And what this is going to do is it's going to allow carriers to come back into the market. Right now, we have rates that are extremely high. And this is what happens when you don't have competition, right? When you have basically no private industry working and people are relying on the FAIR plan, the rate's going to be high. So once the carriers all come back and start competing again, we'll see rates come down.
But Harvey Rosenfield, the founder of Consumer Watchdog, says the insurance companies are intentionally forcing homeowners into the FAIR plan as a way of getting every homeowner in the state to pay the FAIR plan's losses.
From our point of view, we see this as creating a scare tactic to create an opportunity for the legislature to bail the insurance industry out by forcing every homeowner in the state to pay off the debts of the FAIR plan, whether you're in a risky area or not.
As wildfires grow in size, so does the cost of recovery. It is a cost that will eventually be borne by everyone, which means no one will be very happy about it.
And tomorrow, the Department of Insurance will hold a public hearing on the first set of guidelines for the new sustainable insurance strategy.